Hi, I'm Lisa Leiter. In Chicago Business Today, talk of another tech stock bubble. Groupon was reportedly pushing to file for its expected IPO as soon as this week, before bankers had a chance to step in, according to the website All Things Digital. But the report went on to say that the Chicago-based company decided to wait a bit longer. Groupon is just 2.5 years old, and an initial public offering could put its value at $15 billion, maybe more, according to some reports. Also this week, LinkedIn said it was boosting its IPO, which would value the company at more than $3 billion. And all of this comes as talk circulates about a $100 billion value potentially for Facebook. I sat down with Bill Buer, IPO analyst at Morningstar, to talk more about whether we are entering another tech stock bubble, and I began by asking him why the LinkedIn deal is so important to the market.
I think there's some value in being the first one in the pool, so to speak. And the thing about LinkedIn is actually, they have revenue, they have profitability. The company's only going to be valued around $4 billion. They have a nice subscriber base. There's now some ad revenue that's flowing in, and LinkedIn to me looks like the least kind of questionable valuation in terms of these four, and the four I'm referred to, of course, are Twitter, Facebook, Groupon, and LinkedIn. It's actually probably going to be a deal that a lot of investors are going to want to get involved in, but I don't think necessarily that the valuation is that outlandish.
Well, when you talk about an outlandish valuation, some people have called Facebook's potential valuation as outlandish. I've heard anything from $65 billion, you mentioned off camera, $100 billion. What do you make of that?
Facebook is basically in everyone's conscience right now. I mean, it's one of those companies that there's this kind of pop culture or American consciousness angle to Facebook right now. But then you talk about the business aspects. I mean, it's a valuable network. There's no doubt about it. What they have at this point cannot be duplicated. But when you look through the various valuations, in January they said $50 billion. In March they said 65 to 70. Now the latest private investments are talking about $100 billion. They're only going to do $4 billion in revenue in 2011, so you're talking about a 25 times sales multiple. I mean, it looks a little bit rich to me.
We cared the most about Groupon here in Chicago. There was some report this week that they wanted to push through the IPO process, maybe without the bankers complexifying the situation. Does Groupon need to go public right now to harness their popularity right now, or do you think it would make sense for them to wait?
Definitely, they should go as fast as they can. I think this of the four companies, they have the weakest business model. I mean, essentially, this is online. Groupon, they have a first mover advantage in the sense that they got in early, but since they've come in, there's been a lot of copycats. Groupon is at the most risk of having a valuation possibly decline as people really start to climb into the books, evaluate the business model, and see that they really don't have a real competitive advantage at Morningstar, what we like to call an economic moat around their business that would protect it from competitors. And to me, that causes some problems long-term with respect to valuation.
What about Twitter? That's one site that has been talked about as, not maybe having the revenue model to sustain itself. I mean, what would you say about Twitter?
To me, that's one where what's driving the valuation is pure speculation and also what could Twitter become. It's all on potential right now. There's nothing concrete about what would make Twitter that valuable. How do you monetize this business model? I don't think they even know yet. It's still in the early stages, but again, people are kind of looking at it and saying, oh, Twitter, somehow they'll find a way to do it, and because of that, we can expect a lofty valuation. So there's a lot of investor belief in their model, and I'm a little bit more skeptical.
Do you think we are in a tech stock bubble right now? Are we reinventing the late 1990s?
The valuations that are being thrown around makes it feel that way. I'm not going to say we're in a bubble yet because a lot of these valuations haven't come to fruition yet. This is a lot of rumors. It's a lot of kind of under the table chatter. LinkedIn is actually only the first one to actually bring a deal. So I'm kind of in a wait and see mode. But certainly, if Facebook goes off with an IPO and ends up a valuation of $100 or $120 billion, I mean, it's definitely feeling like 1998 or 1999 if that happens, and if Groupon and Twitter follow with theirs.
Clearly, these companies are talking about this now because they must feel like the IPO market is inviting. How have some of the companies done that have gone public this year, some of the bigger names? Have we seen the type of performance that would warrant these companies going public right now?
IPO it's a strange market in the sense that the window can close quickly, and when it does and you're not through it yet, that's a problem. So I think people are seeing the the success of a lot of these IPOs this year, both companies with strong fundamentals and not so. And they're saying, if we're on the sidelines with our filing in place, let's get our deal done now and kind of strike while the iron's hot.
Thank you for joining us today, Bill.
Thanks for having me.
And that's this edition of Chicago Business Today. For all of your business headlines, be sure to stick with chicagobusiness.com. And don't forget to download our mobile app so you can watch us anytime, anywhere. Go to chicagobusiness.com/mobile apps. Thanks for watching. Have a great weekend. We'll see you back here on Monday.